All right, let's just jump right in with a question that honestly sounds a little crazy, right? Is this the recession we need? I mean, it sounds completely backwards, but with the global economy in such a strange spot, some people are actually starting to ask if a shock to the system is exactly what we need.
To really get why we're even asking this, you have to start with this number: $315 trillion. That's not million, not billion, trillion. It's the record-breaking amount of debt the entire world is carrying right now. It's a number so huge, it makes the whole system, well, incredibly fragile.
And that brings us right back to that wild question. Could an economic crash, the very thing we're all taught to fear, actually have a silver lining? It's a huge question, but before we can even try to answer it, we've got to be on the same page about what we're even talking about. Okay, so first things first, what is a recession anyway? You'd think for such a big, scary word, there'd be this super strict black and white definition. But nope. The reality is a lot more flexible. And that's actually kind of on purpose. If you crack open a textbook, it'll tell you it's basically a long stretch where the economy's not growing, or it's even shrinking. Now, you've probably heard the classic rule of thumb, right? 2 straight quarters of shrinking GDP. But here's the thing, that's more of a guideline. See, the word recession itself has power. Just saying it out loud can freak people out and make things worse. So economists give themselves a little wiggle room. To really get what negative growth means, you gotta know what normal looks like. And for the last 250 years, the global economy has been like this incredibly reliable engine, just humming along, growing at about 3% pretty much every single year. And I know, 3% doesn't sound like a huge deal, but this is where the magic of compounding comes in. You stack that up year after year after year, and bam! It means that today the world produces 150 times more stuff every single year than it did back at the start of the Industrial Revolution. That's just a mind-blowing leap. So what does that mean for you and me? Well, think about this. Even though there are way more of us on the planet now, the average person today has access to 20 times more goods and services than someone did 250 years ago. That's incredible. And a recession? That's when that amazing engine we talked about starts to splutter, and then kicks into reverse.
So what makes the engine go backwards? Well, these days, it's usually one of two things, what economists call shocks. A supply shock is when something physically stops us from making things. Think about the pandemic, right? Factories literally couldn't operate. But a demand shock, that's all in our heads. We can still make everything, but we all get scared and stop buying stuff. So companies stop making things, which leads to layoffs, which makes everyone even more scared. It's a vicious cycle, a total self-fulfilling prophecy. And honestly, that's the one we see a lot more of now.
Okay, so if these things are so painful and are often just based on fear, how can anyone possibly argue that a recession could be a good thing? Well, this is where it gets complicated, because a recession really does have two faces. And this quote really gets to the core of the whole pro-recession argument. If you're looking at it from a completely detached, numbers-only point of view, a recession acts like a force of nature. It's a predator that strengthens the overall herd by culling the weakest members. So let's break that down. The good part of the argument is that a recession clears out the unproductive companies, the ones running on pure hype and cheap debt. Remember the dot-com bubble? When it burst, it wiped out tons of companies, sure, but it also freed up all those brilliant engineers and all that investment money for the companies that actually had a future. But, and this is a huge but, there's the bad side, the immense human cost. Recessions don't just take out failing companies, they're messy. They destroy perfectly healthy businesses and cause devastating job losses for millions of people who get caught in the crossfire. And here's the thing, the rulebook has kind of changed. Our modern economy is just built differently than it was 50 or even 20 years ago. There are a few key things about it now that make it uniquely fragile, and that totally changes how we have to think about any kind of downturn. To really get why recessions feel so scary now, you have to understand this one concept: flow versus stock. Think of it like a bathtub. GDP, the economy, is the flow of water coming from the faucet. It's what we produce in a year. Wealth is the stock of water you've already collected in the tub. Now, in theory, just turning down the faucet for a little while shouldn't empty your entire bathtub, right? So why does a recession, a drop in flow, feel so catastrophic? Well, a huge piece of the puzzle is what our modern economies are actually made of. For the most part, we don't make a ton of physical things that add to our lasting stock of wealth. Nope,
The huge, overwhelming majority of our economy today is services. Things like your haircut, your accountant, your Netflix subscription.
And here's the critical weakness of that. The value of a service disappears the second it's created. You can't put a haircut in a warehouse and save it for a rainy day. So when people stop paying for services, the jobs tied to them just evaporate instantly. And the people who just lost their jobs, they immediately stop buying other services. The economic pain is fast and brutal.
And now we circle back to that massive pile of debt we started with. Almost all of that lending was based on one simple assumption, that the economy would keep growing, allowing people and businesses to pay it back. So what happens when that growth engine stops or goes in reverse? Defaults can start to cascade through the whole system, and that's when a small tremor turns into a full-blown financial earthquake.
So all of this brings us to the ultimate question. Knowing how fragile our service-based, debt-fueled economy is, what's the verdict on intentionally causing a recession to try and fix other problems?
Let's go back to that predator analogy. A natural recession, one that just happens from the organic forces of the market, that's like a lion. Yeah, it's brutal, but it's targeted. It tends to pick off the weakest, least efficient parts of the economy. But a recession that we induce on purpose with broad, clumsy policies, that is not a lion. It's more like a poacher with a machine gun. It's not a surgical strike. It's indiscriminate. It just sprays bullets everywhere, taking down the strong right along with the weak, and shattering the one thing that takes years to rebuild: economic confidence. So trying to fix economic problems by intentionally triggering a recession is just a massive overreaction. It's a blunt instrument, practically guaranteed to cause way more harm than good. It's like inducing a coma to treat a headache. Which leaves us with the ultimate dilemma, doesn't it? If the system has real problems, inefficiencies, bubbles, resources in all the wrong places, and a full-blown recession is just too catastrophic of a cure, then what's the right tool for the job? How do you clear out the dead wood without burning down the entire forest? Now that is the real trillion-dollar question.